Hi, this is Shubhankar Chakraborty from American Academy of Financial Management. And today's query is, what are the key considerations when interpreting a VaR result or a value at risk result? Can you explain the significance of confidence level and time horizon in VaR calculation, that's value at risk calculation, and how can VaR be used in combination with other risk measures to provide a comprehensive understanding of portfolio risk? Now, let's one by one take each of these questions. So when interpreting a value at risk result, one has to have certain key considerations, and one is confidence level and time horizon. Now, what is confidence level? Confidence level is at what confidence level you think the loss would be significant. So that is what VAR says, that if you are trying to understand a level at which your risk will be higher. So that is, if you plot a graph and if you consider that only 95% of the times in the data, in the range of data that you're going to take, only 95% of the time you will not be at loss. So rest 5% of the time there will be a loss. So that is the value at risk. So that is a key consideration that we need while interpreting a value at risk. So what we do essentially is we take some historical data, and let's say अगर मैं निफ्टी का एक प्लॉट करता हूँ, लास्ट 2 साल का निफ्टी का प्लॉट करता हूँ, तो लास्ट 2 साल का जो भी निफ्टी का हिस्टोरिकल डेटा है ऑन अ 1 डे रेंज और ऑन अ वीकली रेंज और ऑन अ मंथली रेंज, अगर मैं डेटा लेता हूँ, उस डेटा को अगर मैं प्लॉट करता हूँ और उसमें मुझे ये देखना है कि कितने परसेंटेज ऑफ टाइम निफ्टी पॉजिटिव रहा एंड कब कब निफ्टी नेगेटिव रहा. सो डेली चार्ट में कितना परसेंट टाइम निफ्टी वाज इन पॉजिटिव और वीकली चार्ट में कितना परसेंट निफ्टी वाज इन पॉजिटिव. So and it is important to maintain this time horizon, which is the second consideration that we will come into. So that in that consideration, let's say for example mera 95% of the time I'm seeing that Nifty is giving a positive return. So that means my value at risk is only for those 5% of the time. So the higher the confidence level, the higher is the chance of not having that loss, or the higher is the risk aversion, right? So that is what confidence level does. I mean, that is how confidence level is a consideration when it comes to interpreting value at risk. The other one is time horizon. Now, it is important to have a time horizon on a weekly basis or on a monthly basis or on a yearly basis. Now, let's say I plot a daily chart for 2 years. That is giving me a huge range of data, and it is always better to have a higher or a longer time horizon, a data over a longer time horizon, because that gives me that gives me an understanding that Nifty or any market or any investment might have gone through a series of events, right? अगर मैं 1 साल का निफ्टी का horizon देखूं या 5 साल का निफ्टी का horizon देखूं या 10 साल का निफ्टी का horizon देखूं, तो ये सारे डिफरेंट होंगे. पिछले 1 साल का निफ्टी का horizon अगर मैं देखूं तो उसमें कोविड नहीं आएगा, लेकिन पिछले 5 साल का अगर मैं निफ्टी का horizon देखूंगा तो उसमें कोविड आ गया. So that's a major event that happened, and there have been other subsequent events that happened along with it. अगर मैं 10 साल का देखूंगा तो उससे भी पीछे का जो भी इवेंट है वो भी यहाँ पे फैक्टर इन हो रहा है. So longer would be your time horizon, the range of data would be higher, and that would be giving a risk aversion to your interpretation of VAR. So that is another consideration that you take. So a risk averse person would always want a confidence level to be higher, and at the same time over a longer horizon. So if you say you are having a confidence level of 95% over a time horizon of 10 years, that technically means that 95% of those 10 years, then your target asset class which let's say, for example, Nifty has been positive. So that gives him the confidence that, this is an asset class that I would want to get in, because 95% of the time over the last 10 years, it has given a positive return, right? But this is the significance of it. So the higher the confidence level and the higher the horizon, the greater is the risk aversion, and vice versa. But what is the limitation of VaR? There's a limitation of VaR, and the limitation is it always considers the previous data. So whatever you want to interpret and whatever you want to plot, the data will be always historical. It sometimes doesn't follow accordingly. So the trend that you have seen in past 10 years might not follow going forward. So that gives you a very limited view of risk. And that is why you should not be using only VaR while interpreting or considering or understanding, for that matter, portfolio risk, which what brings it to the other risk matrices. So that is a limitation of VaR. Now, to provide comprehensive understanding of portfolio risk, it needs to be used in combination with these matrices. Now, the first one is expected shortfall or conditional value at risk. So value at risk gives you an understanding of that what is the confidence level and what is the time horizon. Now, expected loss, or ES, gives you the understanding of if it falls under those 5%, which is where the loss is going to happen, how much would be the loss? Now you see, you are getting a better idea that so far VaR was telling you if it has got a 95% confidence level. So if in the risk exists in that 5% part, and it doesn't tell you how much that risk is going to be. How much will be the loss? It doesn't tell you that. It might be zero. It might come down. The valuation might come down from 100 to 0. But whether it will come down, nobody knows, because VaR only gives you that there will be loss. It doesn't talk about how much it will be. So expected loss, shortfall, or conditional VaR, it gives you an understanding that how much, if there is a loss, if an event happens which comes under that 5% part, whether the loss is going to be this much or more. So that gives you an understanding of or quantifies the loss. Kitna nuksan hoga wo bata deta hai. And the second thing is stress testing. So events that has happened in the past, VaR only gives you an understanding of that, or VaR gives you a data or an understanding based on the data that has been plotted, which is historical. Events that has happened in the history is been factored in, like COVID has been factored in. If you take a 10-year horizon, then maybe taper tantrum that happened in Indian market, the interest rates which went down in Indian market, which went up, and the inflations, those were considered. Now, whether those kind of stresses will persist or whether there will be some more stress situation, we don't know that. And if your portfolio goes to a stress testing where we will put a scenario where Nifty will come down by 55-60%, whether your portfolio will hold its position at that point. So that is a stress testing that you do. So that's another matrix that you can use along with VaR to understand what kind of loss are we talking about, or what kind of risk is there in the portfolio. The third is correlation analysis. In correlation analysis, what happens is we correlate one asset class with another and see कि इन दोनों में क्या relation है. So if my equity is coming down, how in this kind of scenario, whether my debt will also come down, what will happen to my commodity investment, whether that will come down, what will happen to metal, whether that will come down. So this is the correlation that we try to create. So this is called correlation analysis, where we correlate one asset class with another asset class to see what each of these asset classes, if I put all these asset classes in one portfolio, how my portfolio is going to react. So what will be the risk of that portfolio based on that correlation. So that again gives you another measure along with VaR and expected shortfall and stress testing. It gives you another measure to understand the risk of your portfolio. And the fourth is risk decomposition. So if you have 4 or 5 elements in your portfolio, you granularize it and go to each one of those asset classes and each one of those components to see how much this component is contributing to the risk. All right. So if your portfolio is having, let's say, equity, debt, commodity, gold, and crude, maybe let's say crude oil, that's another commodity. So gold, crude oil, equity, and debt. Now, if your portfolio has got these 4 elements, whether how much of the risk is being contributed by equity, how much is contributed by debt, how much by gold, and how much by crude. So now you are decomposing the risk. So each one of these components, you are getting an idea of how much the risk is going to be. Based on that, you can create your portfolio. You can do your asset allocation. So if you are a risk averse person and if you see that equity is giving me more risk, then you will be bringing down the equity and probably allocating a little more in debt. So this is how it, VaR along with these risk measures can give you a comprehensive understanding of portfolio risk. I hope I answered your question. Thank you.